Good morning, one and all. Welcome back to the Commodities Weekly Audiocast with me, Ravindra Rao from Kotak Securities Commodity Research Desk. The much awaited US non farm payrolls, or as it is widely quoted, the NFP print, was out last week. As per the data, the unemployment rate increased to 3.6% from 3.4% in January, which was the lowest in almost 53 years. The data release was slightly underwhelming, with wages also dropping below expectations. That aligned with the belief that January data was an outlier. However, the non-farm payroll still added more jobs than expected in the month of February. Earlier in the week, uh, uh, Fed Chair Jerome Powell had unveiled a hawkish tilt by indicating that the central bank is prepared to increase the pace of rate hikes if the totality of the data were to indicate that faster tightening is warranted. Powell also noted that the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Markets took Powell earnestly and dollar index surged to a 3-month high of 105.88 level, while US 2-year treasury yields, a proxy for short-term rates, skyrocketed to a fresh 15-year high of 5.08%. Interest rate futures started pricing in Fed funds terminal rate at 5.66% by September 2023 and almost zero cuts for the year. Then came the NFP print, and the market reaction was to go with the drop in wages and higher unemployment print that pulled the American currency lower. After the NFP print, the dollar index fell to as low as 104.03 as the data hinted that inflation pressures are easing. That led to bets the Fed could move ahead with more modest rate hikes than previously anticipated. DXY closed the week with mild gains, but much lower when compared to the high of 105.88. Technically, the dollar index has formed an evening star and it took resistance near the 252-day moving average. But the evening star confirmation will come on a close below 104.20, and in that scenario, the fall might extend much lower till around 103 point. It's around 103 point. 103.48, which is the 52-day moving average support, and there it might take a support, but we expect a fall in case if it closes below 104.20. Coming to precious metals, COMEX gold prices started the week on a negative note, plunging almost 2.5% in first 2 days. The yellow metal approached an 11-week low of $1810 per troy ounce notched in the previous week after Fed chair's testimony. Stronger dollar and US 10-year treasury yields weighed on the non-yielding bullion. However, slower wage growth, as indicated by the US NFP print, and risk-off in the global markets amid fears of contagion in the US banking sector pushed investors towards safe haven assets that helped gold rebound sharply above $1870 per ounce. It closed the week with a gain of around 0.70%. COMEX Silver 2 staged a recovery and closed at 20.60 per ounce, limiting the decline to 3.5%, cushioned by gains in gold. SPDR gold holdings slipped to 903 tons, while iShares silver holdings saw a minor 510 outflow, hinting towards weak investment demand. Focus now shifts to US CPI data in the week, which will give clarity on whether Fed will go for a 25 basis point hike or a 50 basis point hike in their upcoming March 22nd meet. Technically, gold has formed a morning star, and it has been confirmed. However, there is a 52-day moving average resistance near $1871. So the bulls have to close the prices above 1871, 1872 zone for it to take it higher towards $1900. So that remains to be a resistance, and support now would be near the immediate support would be near 1835, but the strong support will be at 252-day moving average support near 1809, which also coincides with the morning star support. In case of silver, silver has recovered from the lower levels. So the support now remains near 19.90 dollar per ounce, whereas resistance is near 21.18 immediately, and above that, strong resistance is near 21.58, which is the 252-day moving average resistance. So we expect 1990 to hold, and if that holds, we might see a spike up to 21.20 to 21.50 on the higher side. Coming to energies, crude oil prices closed the week with a 4% decline, reversing most gains made last week as US recession woes and weaker Chinese import figures weighed on demand outlook. While a surprise 1.7 million barrel drawdown in US oil in crude oil was largely ignored by the investors. Fears of a looming recession in the US weighed on risky assets as US 2-year Treasury yields reached 5% for the first time since 2007, while 10-year Treasury yields hovered near 4%, leading to a percent point inversion for the first time since 1981. China's crude oil imports during January-February totaled 84.06 million tons, or about 10.40 million barrels per day, 1.3% lower compared to 10.53 million barrels per day in the same period last year. For the week, oil market attention will be on the US CPI data, as that would give a clarity on Fed's stance in their upcoming FOMC meet. Technically, crude is the path of least resistance is still down, but on the downside. But it is more of a consolidative trade that is going on in WTI crude. It is trading in a triangle pattern, and the resistance is near $82.50 and support is pegged near $72.50. So a break on either side would give a direction. Till that time, we expect it to consolidate in this very range. The immediate resistance being $78 on the higher side, and immediate support being 74. In case of MCX, the support is near 6,000 on the lower side, and immediate resistance is near 6,400, 6,420. If it sustains above that, it might again move higher to retest 6,550, 6,600 levels. In case of base metals, LME metals, base metals have extended declines in the week and closed the week with 2 to 6% downside, hurt by Fed rate hike jitters, uncertainty over Chinese demand outlook, and faded optimism over major stimulus measures from China. Trade data was also underwhelming as China's imports of unwrought copper and products were 879,000 tons in January and February, down 9.3%. In the same period a year earlier. This was mainly because of higher global prices that curbed buying appetite. Besides, tightness concerns from Peru is likely to ease as the government expects shipments of the commodities to begin to normalize within days. Aluminium slipped below $2,300 a ton as market focus shifts to demand prospects, with production cuts in Yunnan province completed. If Chinese retail sales and industrial production manage to show green shoots of recovery, it may revive demand optimism and might cushion industrial commodities. On the technical front, copper is still looking to move on the downside until the resistance of 764, 765 holds. On the lower side, support is pegged near 742. If it breaches that, the next support is straight near 734, and the final support is near 717, which is the 252-day moving average. So the immediate level to look at would be 742. A close below that might turn it more weaker. Similarly, on the higher side, 763, 764 above closing might once again regain bullish momentum and might push it higher towards 780. In case of zinc, the view is still lower, but we feel 258, 257 would be a very good support. Until that breaches, there is a possibility it might trade in a consolidative zone. But if it goes below 258, 257 on a closing basis, then we might see zinc prices moving further lower towards 250 to 250 kind of levels. In the week, global markets may remain spooked as a collapse of tech-focused lender Silicon Valley Bank have raised fears of a contagion in U.S. banking sector. So SVB crisis, along with wage data, has also raised the prospect of a 25 basis point rate hike, which could weigh on the dollar. Besides, U.S. CPI and retail sales will be closely watched to see impact of rate hikes on price pressures and consumer appetite. ECB is widely expected to announce a 50 basis point rate hike at the next week's meeting amid stubborn inflation woes. To conclude, commodities are in for yet another volatile week considering the lineup of important events. Thank you, all the best, and trade safe.